Welcome to our High Rock monthly video for February. I'm Scott Tomlinson, and with me on the call is my partner and colleague and the founder of High Rock, Paul Tepsich. Diane Leckie is very busy working on our quarter end and year end reports. We have been inundated with a few projects, including a new look website, and we'll talk about that a little bit more towards the end, and some small glitches in one of the cash equivalent um, issues that we own, the BMO High Interest Savings Fund. BMO changed the coding on that, but didn't let us know. So all of a sudden, when our independent pricing source went to determine the price of the code, the old code was had been disengaged, so it turned up as a 0, which did put a few glitches in our portfolio values. But we've had that all sorted out, although it did happen over the weekend, and that was month end. But everything's been resolved and put back in case anybody had seen any issues in their portfolio values. It wasn't market related. It was in fact just a glitch in coding. So anyway, let's move on. January was an interesting month in financial markets. What most of our correlated financial our correlated assets, as in correlated to stock and bond markets, didn't really change a whole lot. But a fair bit of volatility at the end of the month did drop prices from slightly higher levels. But in the end, most equity position or equity markets were lower by 1% or slightly less. Our gold silver position was a little bit lower, and Canadian bonds were a little bit lower. The only really standout was the Canadian preferred share index, which was higher on the month. But as I said, we did see some interesting developments in some of our non-correlated assets, and I am going to turn it over to Paul to talk a little bit about what went on there.
Sure, thanks, Scott. So first of all, we had 2 weeks ago, or just 2.5 weeks ago, perhaps, one of our solid holdings, which I really liked, is Atlantic Power. It is an independent power producer in Canada and the US. And we owned 2 securities. One was a senior unsecured high yield bond that we owned in the fixed income bond. That was in our fixed income model. That was part of the high yield portion within the fixed income model. And the second one is we're looking now is the Atlantic Power preferred shares. There were 3 preferred shares outstanding. We owned 1, and that was in the tactical model. As you can see in this chart, some newer clients maybe even bought this down around the $10 area. Preferred shares are priced at $25 par value compared to a bond at $100 par value. So anyway, this preferred share was trading around $17 before this announcement came out on a Thursday night almost 3 weeks ago. And the company acquiring Atlantic Power in entirety is doing so with cash on all securities, including this preferred share. They said they're taking out this preferred share at $22. Now, don't forget, $25 is par value. So I've spoken to the CFO of Atlantic Power. I've spoken to a few other preferred shareholders who I know, and we are trying to get the acquiring company to pay $25. Now, on the amount of this entire acquisition, which is $1 billion US, moving from $22 on all 3 preferred shares to $25 would only add about 16 million US on a $1 billion acquisition. It's not a lot. And the reason why we're pushing for that is because if they don't pay up and we don't agree to sell our shares, then these shares would stay outstanding, and the new acquirer, it was called I Square Capital, it's a private equity firm in the infrastructure space would have to leave these preferred shares outstanding, and they would have to be a reporting issuer, which is not something a private equity firm typically wants. So right now they're marked just below $22, around $21.80. But we think there's a little bit more upside. There's an option, not an option, maybe optionality or a bit more upside if we can go from 22 to 25. There's a little bit more juice in it for us. Nonetheless, we're going to hold it. We will get another dividend payment on the preferred share in March, and this should close sometime in the second quarter. So I would say sometime in June. So maybe go to the next slide, Scott, and we're going to see what happened to the Atlantic Power bonds that we owned. They were priced around $92, $93 before the news came out 3 weeks ago, and they're up at 105.80 now, but the takeout price is actually 106.33. Plus, we're going to get accrued interest or carry in the coupon all the way until the day before the transaction closes. So again, until let's say June. And that will work out to roughly another 2.5 to 3 points. So that bond is going to continue to provide us with very good coupon interest payment until then. So again, we will continue to hold that bond. That bond has already effectively been voted in favor of the deal by one large holder that held over or about 2/3 of the entire outstanding of the bond. So there's really no more upside to this bond other than the carry. Nonetheless, those two positions ended up really adding value to our month of January. So those were big contributors and just an example of how we pick securities and bonds that are low correlation to the markets, provided us with great interest income and dividend income in the preferred share. The good news is we get taken out at a pretty stellar premium. The bad news is we have to replace that coupon and dividend income with something similarly positioned where it's a low correlation asset to the market.
Now, Paul, just historically, we've owned Atlantic Power pretty much since the inception of the High Rock Private Client division, correct?
That's right. It's been one of my favorite bonds, that and the Yellow Media bonds, which is, there's only one left, and it's going to be gone in early June as well.
So the interesting story here is that, you know, we do own some of these, what we call non-correlated. So they're not necessarily moving in sync with the prices in other financial markets in general, that they'll, you know, it's moving on their own accord here in this particular situation. But we do buy these with a longer term perspective, of course, and not necessarily looking for something like this to happen. But what happens is these non-correlated assets tend to drive the risk in the overall portfolio lower, at the same time as providing us with a very decent income stream. And one of the things that we always have to be aware of when we're looking at our portfolio performances over time, and sometimes comparing ourselves to other benchmarks, stock markets, bond markets, things like that we do compare ourselves to, these non-correlated assets may at some point or may not be adding or detracting from that performance. So it is something that we always have to keep in mind when we are comparing our portfolio performances to general market conditions, and that's why we really like these non-correlated assets when we can have them in our portfolio. And congratulations to Paul for picking one that has done us so well over time.
Yeah, you're right, over time. And you know, on average, Scott, both of those securities, the Atlantic Power Preferred and the bond, you know, were yielding around 7% plus. That's just a spectacular return, and we should probably mention the rule of 72, which states that if you can get a 7% return over 10 years, you double your money. Now, we're not advertising that because this is just two specific securities, but boy, it does add low volatile income stream through that yield. And something we're going to miss, but again, happy to be taken out at a premium.
Yeah, that's great. Great work. Okay. A couple other things, Paul, you want to talk about that happened in January?
Yeah, I'll be pretty brief on these. In the tactical model, we own a few positions that we will just look at quickly. One of them is a Crew Energy bond. It's a 6.5% coupon due 2024. This bond, as you can see, was hit down really hard and really kind of just languished for quite some time, like all energy bonds did. This is a natural gas producer in the Montney section of northeast BC, very, very well situated for LNG Canada to actually get a lot of natural gas onto the pipeline system to get the Tidewater in BC to the LNG Canada facility once it's up and running, which is still a few years away. I think ultimately this company will be taken out in a few years' time. Nonetheless, there are two things that went on that drove this, as you can see in the pricing of this bond before Christmas was sitting around 60 cents on the dollar, and then popped up to 70. Now it's today at 86.25 bid. So it's really bounced back nicely, and part of the reason is that they came out and said they were going to increase production over the next 2 years by about 50%. So they are going to borrow a little bit more money from the banks, so draw down on their credit facilities with the banks through 2021 and 2022. They should be starting to pay some of that down substantially with cash flow, just on where natural gas is priced in the forward market, the futures market, so where they can sell it out in the future. So I really like this, what they're doing, what the company is doing. And again, the same largest holder in the Atlantic Power bond is the largest holder in this Crew Energy bond, which I like. And I think he is on side with what the company is doing. So that's one situation that's, again, obviously gapped up, but it's still adding a little bit of value. And again, Scott, if I look at, if you can just bear with me, that bond where it's priced now is still yielding around just under 12% on a yield to maturity basis. It's pretty stout, and we will continue to hold it. Why don't you move to the next one? Ensign Drilling. This is a drilling company in North America and also in the Middle East. It's owned, I call it a Murray Edwards company, who's the chairman of CNQ, which is one of the big three Canadian oil and gas companies. He owns 20% of the stock in Ensign Drilling, and he also owns a whack of bonds personally. This one, as you can see as well, before Christmas was kind of languishing, and it was around 40 cents in the dollar, and then popped up to 60 cents in the dollar. It's very difficult to see on this chart. And then you can see it popped up again in January to 70 cents in the dollar. So it's had a pretty stout move as well, and playing catch up. And these energy names like Crew, Ensign, there's a couple others that we don't own that were kind of left behind when, since March, everything went crazy. I mean, investment grade bonds yield 1.5%. Average non-energy high yield bonds yield 3%. So when you get something that's yielding 12, like Crew Energy, or Ensign is yielding 23% at 70 cents in the dollar, it starts attracting some money. So there are buyers coming in. I think there's something going on with this company. I won't get into a complicated explanation of what I think they're going to do within their capital structure, but what I will tell you is that they've been buying back, the company has been buying back a lot of bonds over since March, and I think they will do something that will enable them to continue to buy back bonds aggressively. So again, we like this situation and look forward to maybe the gains will moderate, but again, at 23% yield on this bond, I'm happy owning it, knowing that Murray Edwards owns equity, which is way beneath where we own these bonds. Again, that's another discussion, but it's a very important factor for us when we own the bonds.
And you wanted to talk a little bit about silver. And interestingly enough, I had a client email me today asking about silver. So I'll let you go with that.
Well, we did buy some silver on Monday, and there was a people are probably well aware of what's going on in specifically in the U.S. markets with this GameStop and whatnot, and there was speculation that perhaps some of these Wall Street bets traders on Reddit were taking a run at silver, which I don't think is necessarily happening, but it did highlight to people how far off physical silver is versus what I would call paper silver or paper gold, these ETFs that are supposedly tracking the underlying of the commodity. And they don't. But what we are looking at here is just the price of silver in the red. And the reason why we already own some silver, and people our clients listening would probably remember that we own one which is 68% gold and 32% silver, and they're both physical, held at the Royal Canadian Mint. So we don't own futures contracts, we don't own paper gold and silver. We own physical silver. We can actually physically take delivery of it if we want. But I always wanted to own some silver, which we did, but I wanted to own a little bit more. And with this speculation out that there's a massive difference between the paper silver markets and the physical silver markets, we wanted to have a little bit more exposure. So we didn't buy this, obviously this is pure silver, but we did buy another Sprott fund, which is pure silver, and again, held at the Royal Canadian Mint. We might have been a little bit early on it, but nonetheless, and part of our rationale here is that because the physical silver market is getting so well bid or in such demand that some silver coin and gold, but silver coin merchants couldn't actually make delivery because the demand they had would outstrip their supply. So at some point, our view is when the U.S. Mint just came out yesterday, in fact, and I should have put that in this chart, Scott, but it was just yesterday the U.S. Mint said they couldn't meet physical demand. And the last time that happened was in June 2010 when they said we can't meet physical demand for silver. You can see what happened. I mean, it went from just under $20 to, damn close to 50 within a year. And I think that could happen again. You can see it's been happening through 2020. And I think we can see this thing pop up again. So silver and gold are obviously traditional stores of value and potentially a hedge against inflation. But right now, I think there is a certain dynamic in the market that physical or these ETFs are going to have to catch up to the physical market. So there's very much tightness or overriding demand for physical silver right now. So we brought a little bit more exposure to it, and we'll see how that plays out.
Well, what strikes me too here is that the price of silver started to historically after the last recession, 2008, 2009, after a little bit of up and down and determining whether the economy was actually going to strengthen again. That seems to be what happened to silver. So you're right. We may be a little ahead of ourselves, but it does strike me that from a historical perspective, we may actually see silver spike up again as the global economy gets back on its feet on the other side of the COVID pandemic.
Yeah, exactly. Well, we'll see. And for now, we're not going to buy any more. We'll leave what we have and see how it plays out.
Excellent. Okay. So again, we want to remind all our clients that our true focus is on long-term goals and goals-based long-term planning, and that is what we strive for. But we have to try to find opportunities, and sometimes those opportunities do take a fair bit of time to play out. But as we've demonstrated with our Atlantic Power holdings, once they do play out, it is a very, very positive situation for our long-term portfolio performance. So, what are we worried about? Well, we still worry about the coronavirus. I think what we worry about the most is the new strains that are more contagious and how those will be held in check. We know that vaccinations are ramping up, but we also know there's some political issues behind stronger or more readily available vaccinations, and we have to be cautious and vigilant of how that story plays out. We do, if you look down in the very low right-hand corner, we can see that daily deaths sort of peaked around the end of 2020, and as we move into 2021, they're starting to show a little bit of decline, which is a great thing, obviously, but it may push this out a little further. And I noticed today, in fact, Angus Reid released a new poll asking Canadians what they think about their life going forward over the next 12 months. And still well over half of Canadians, and different in some jurisdictions, but basically over half of Canadians think that life is going to continue to be pretty tough to deal with. And I think that does point towards the potential for economic growth, because we know that if consumers and businesses are not comfortable, if they're continue to be hesitant to spend, that's not necessarily going to be good for the economy, especially in the near term. So obviously, we have to keep consumer sentiment in mind, and these kinds of analysis play into that. We'll watch it closely as we go forward, but this does concern us for sure. Bubbling markets, again, we talked about this a little bit before. This is the extension of them. Obviously, Bitcoin hit a top and pulled back into a over 20% correction, which did put Bitcoin back in a bear market. But as you can see, there's significant volatility. A lot of people ask me, what my thoughts are on Bitcoin as a currency going forward. And my concern, obviously, is it will maybe turn into a currency sometime way in the future. But as long as there's this much volatility, as a store of value, it's really difficult, because with our currency, we have a central bank that has a mandate to determine the actual stability of the currency. So they have control over the volatility in our currency, and as we see, it's not anywhere close to what we're seeing in Bitcoin. So until Bitcoin is able to come under a little bit more of a stable situation, I don't think anybody really wants to see the potential inflation or deflation in their monetary holdings go up or down by 15 to 20% in a very short period of time. And I think that's a problem for Bitcoin in the near term. In the long term, we'll keep our eye on it.
Yeah,
Paul mentioned GameStop. That's another. Oh, sorry, Paul. Did you have something to say?
Well, I was just going to add Bitcoin. Even over the past month or days, you look at this thing, Scott. Like, it can't be a store of value, and maybe it is over a really long term. But I'll tell you, over a short, medium term, it's up or down 5, 6, 7% a day, 10%, 15%. That is not a store of value right now. That is wicked volatility.
Yeah, and it's
and
very
that brings
much
us to the next one, GameStop, right? Yeah. Is complete speculation. I think with this Reddit crowd, which people are largely familiar with now, I'm sure, over the past couple of weeks. But the company fundamentally is, the hedge funds were probably right. It's probably worth nothing. Now, they were wrong, because they were short the stock, and it worked out to about 159% of the outstanding float, or the outstanding amount of shares. These guys were short almost 160%, which is insane. If you see a short interest like that of 20-30% is a lot. 160% is insane. So that's the difference between some of these. Tesla is a real business. Obviously, BlackBerry is still a real business. Should it have shot up the way it did? No. It was just a lot of people, a lot of investors, specifically these hedge funds, were all lined up on the same side of the boat, short the stock, and they had to go cover, and that's what drove it higher. Again, a very technical situation.
And again, and I think the word investors is a dubious term here, because they're not necessarily long-term investors, and you use the word speculation, and that's what it is. Hedge funds shorting companies is speculation that the stock price will go lower, but it's not what we would classify as long-term investing. And I think there's a big difference that we have to take into consideration here. As long-term investors, these aren't situations that we want to put ourselves into. It is perhaps for speculators, and I refer to them often in my blogs as gamblers, because that's what it is. And when there is too much money chasing too few assets, as we're seeing as a result of all of the monetary and fiscal stimulus that's coming in and expected to come into the global economy, this is what happens, and markets get bubbly, and as a result, there's vulnerability if you do start to get involved in some of this day trading, speculation, or gambling, as I would call it. So the market, in a lot of cases, has become a bit of a casino, and it's just something that, from that perspective, we have to be vigilant, but we want to be able to make sure that we're properly taking proper risk with our client portfolios.
And Scott, I would just add here too, just for our clients' benefit, to communicate that none of our mandates, none of our clients, we never short stocks. So we would never be caught in any of these so-called short squeezes where you saw GameStop or BlackBerry or even Tesla, I think, that hurt a lot of hedge funds. So we don't engage in short selling, so we would never get caught in that. We could virtually, I guess, by virtue of that, we're long only, so we only buy stocks and bonds. We never short them. We could be a beneficiary of one of those, perhaps, but it's not something we go in search of at all. We're more based on fundamental analysis than we are in pure speculation.
Absolutely. And speaking of fundamental analysis, one of the metrics we constantly look at and update you on monthly is where earnings are looking relative to prices. And of course, they remain expensive. And for us, it just makes no sense to be putting your hard-earned money to work in assets that are as expensive as they are. Even if they might get a little bit more expensive in the short term, we know in time that everything reverts back to its averages, its means. And you can see that the 10-year average is the dark blue line. The 5-year average is the checkered green line. I should say the 10-year average is the checkered dark blue line, and the 5-year average being the checkered green line, but obviously well above their averages. And for us, it just makes stocks very, very expensive at their current prices. And again, this goes back to the bubbly nature of markets with all of the stimulus that has been put into the global economy. What does excite us? Well, we know that at some point in time, the global economy will come back. We know that this will probably happen as we enter into 2022. Maybe it'll take till 2023, dependent upon how we are able to tamp down the coronavirus. And certainly vaccines are a helpful situation, but we've got to monitor it closely, because if the world slips back into what we might classify as a double dip recession, of which there is a very good chance, despite some of the stimulus coming from from governments globally, then we have to be, somewhat cautious, because that will impact earnings and, of course, impact the fundamentals, and probably pull markets back as well at the same time. Our plan for 2021 is still to look for growth, to find value. We are keeping an eye on what's going on in the Asian markets. Certainly, their economies are definitely coming out stronger, and we do have some exposure to China and Asian markets in a small way. And we will look to add if and when we find value. Paul, you've already talked a little bit about silver. Anything else to add in the tactical strategy?
No, not much other than what we spoke about. We are still waiting our Boralex shares that we sold after a quick 25% return within a month in early December. They've come off. They're below where we sold them, but I've got a buy target that is still about 10% below where they're currently trading. So that's on the buy list for sure. Feels to me like a lot of money was moving into these green energy plays, and they're fully valued from a fundamental perspective and not getting much of a lift, whereas the old school hydrocarbon energy names just skyrocketed, as we saw in our bonds that we showed earlier in this deck. So we didn't own any specific hydrocarbon energy equities or stocks, but we did make that play through the bonds. So, and nothing really, no real changes in fixed income. We bought a very small amount of a new issue in Videotron, which is Quebecor's cable provider and cell phone provider. But that was pretty small, and we'll do some adjusting there to get that weight up to the proper weight.
And as you mentioned earlier, when it came to Crew Energy and Ensign Drilling, people are looking and still searching for yield. And I guess that's something that we're going to have to do as we get closer to the maturity or the buying out of our Atlantic Power bonds.
Yeah, and as I mentioned too, that Yellow Media bond is going to be bought, taken out by the company in May 31st. So call it June 1st at some point. There's one other company I've been looking at. It's a convertible bond that would replace some of that yield, but it is, it's a bit more volatile, and it has run up. So I'm not anxious to buy it at this level. I really want to see some weakness before we step in to buy it. But it would be partially a suitable replacement, but I would not feel as strongly as I did about the Yellow Media bond or the Atlantic Power bond or pref.
Excellent. Okay, well, thank you for all that input. Well, that's it for this month. One thing that we will be sending out shortly is we've revamped our website, so we have a new look, and that is likely to be online. We're hoping tomorrow, or perhaps on the next day, but we will be sending out this video, hopefully on that new on the new website. So if you're listening to this, you're probably on the new website. So maybe you have a look through, and as always, we're really happy to get anybody's feedback, clients, prospective clients, if you're listening, and anybody who else wants to chime in. So have a look through and see what you think. Let us know what you think, and we'll be happy for that. But that's it for this month. We wish you all the best. Stay safe. Hopefully we'll be getting closer to getting vaccinated, and for those of you who want to get vaccinated in the near future, and we'll be looking forward to coming back in the beginning of March with our next edition of our monthly video.